there was one standard, IAS 18 and IAS 11. IAS 18 is about revenue recognition, how you recognize the revenue or when you recognize the revenue. And IAS 11 construction contracts. IAS 11 is construction contracts. So then IASB went on to research, and what they did, they removed these two standards, and then they came up with IFRS 15. They combined both the concepts of revenue and the contracts or construction contracts together, and then they arrived at IFRS 15. Now, in this IFRS 15, there are certain salient difference between IAS 18 and IFRS 15. When revenue should be recognized. To talk about that, let's say I want to purchase one TV. I go to Lulu and I go to this electronic area. I do a complete observation or searching or looking for a nice TV, and I come out. Can Lulu book sales? Lulu cannot book that as a sale. Then next day I go, not only me, I go with my wife. Then we spend how many hours? 5 hours. He is saying 3 hours. So again, too many questions. How this TV, how many inch, and then it's a flat TV, smart TV, 4K, all the questions you scratch that salesman head. He is done.
You will know if the salesman is
Yeah, he may commit suicide. But what nonsense is this? Again, we cannot. In between, I recall one story. Guy has gone to a shop and shown device and said, I need to buy this TV. The salesman said, sir, sorry, we are not selling TVs to you. Then he was a bit upset. Actually, this guy is with the turban. With the sheep. You know, these people know sheiks. Sheiks, you know sheiks? You see sometimes on the road people go with their Then next day he thought, because he realized that I'm a Sikh, and he changed his dress code, wear suit and all that, and again went to the shop, again pointed that and said, I want to buy this TV. He said, sorry sir, we are not selling TVs to you. He's even upset. How come he get to know that? And then he removed this turban into a barber and then haircut. He done everything, and then again he went. Again pointed that I want to buy this TV. He said, no sir, I am not selling TV to you. He said, bloody hell, how you know that it's me? Sir, you are showing an electric oven, microwave, and then asking a TV. Only you will do this. So anyway, coming back to our topic, see, this example of Lulu. Then third time I go and I make I say that okay, I am reserving this TV. I am reserving or confirming this TV. Tomorrow I will come and buy. Can I book the sales, or Lulu can they book the sales? No, they cannot book the sales. Then I go with 100 real advance. I pay that advance. Then I okay, next week I will come and buy. Can Lulu book the sales?
No. Yes, but no.
I pay 100 real advance. TV, let's say price is 3,000.
One payment.
So Sulaiman.
So what should be the double entry for that 100 there?
You should know this word.
Advice to somewhere.
Advice?
What is the
Advance.
Advance, yeah.
advance from customer?
Yes. And
In the books of Lulu.
advice to somewhere.
Custom.
No, in the books of
The books
Lulu.
of Luru, he is a customer.
Yes.
So advance from a customer,
Yeah.
which is a liability.
Yes.
Yes. So you debit bank or cash and you credit to advance loan. So you keep that money. And then there may be terms. Maybe this is non-refundable, or if you don't decide within 14 days, money becomes freeze, something like that, you will have to. Next, also there are other terms like who will take up the delivery. The rule is going to come and fix the TV at your home, or you're going to receive the TV in the warehouse of the or outlet of the Lulu. So that is another situation. Now I take the delivery now, and I agree to pay next week. Lulu will not do, but I take the delivery. I receive the goods. I sign the what was the paper, receiving order, and they gave me the invoice. I received the goods, and I have gone. So now, who can Lulu book sales?
Yes.
Yes.
They collected that.
They collected the item. Now what will happen if this fellow don't pay later?
Legal more.
That's another action. You take legal action one side, and then in accounting side you make a provision for. You conversely, I pay full payment for TV, class, but I didn't take the delivery. They said that sir, we can only say we will deliver you. Or TV is not at the moment available; it's in the warehouse. It will come in 3 days time, but you need to pay now. So, I'm in hurry, I pay full advance. Now, can we recognize the sales?
Yes, you can.
For me, yes.
For you, yes. What about others?
Because it happened to me.
Why?
It happened to you?
My washing machine, it takes 7 days before they give it to my house.
But you paid in
I
full.
paid this one.
So when you think they now suppose in between you decided not to purchase the washing machine,
And it's already in the contract. You already
What?
paid the money, you cannot pay
but
the
they have written that in the contract that you cannot.
That's already handed the money.
What do you think, Mr. Rashad?
You recorded
Okay.
debit of cash, credit,
Pull it out.
different effect revenue.
See. The question is, now this is the main difference between IAS 18 and IFRS 15. Now before, in IAS 18, how they saw to recognize revenue based on who is taking up the risk and rewards, who is undertaking both. That point only you recognize sales. But IFRS 15, what they say, who is securing control. The point in time when you secure the control of the goods and services, that's the point to recognize sales. So you got to understand correctly the terms of the sale agreement for that any particular scenario. Now, then again, now this is one thing that you need to understand correctly. Secondly, Now, the standard name, what is the standard name here? Revenue from contracts with customers. So, there are certain steps to follow here. Step number 1, we need to identify the contracts. Whether there is a contract or not, that should be identified, and whether that contract is clearly addressing the scope that we are looking at. You can think of different possibilities. You can think of sale of goods, sale of services. Now sometimes we buy photocopy machine. Let's say then this when we purchase, that comes with certain different scopes or terminologies or terms, in other words, such as they say that okay, first year maintenance or second year maintenance, third year maintenance we will undertake, or a 5 years warranty and so on. This every single aspect should be included on that, which we needed to identify. Let me open something.
It's like when you buy invoice from market.
Right. Now, first you need to understand the definition of contract. We talked about the way we form up a contract, correct? There are how many methods we can form up a contract or an agreement? Remember this or not?
Yes.
Formal
Yeah.
and informal.
Tell me.
The formal.
Formal, okay.
Agreement
By the verbal
and informal.
contract.
Informal?
Inform.
Verbal? Is there anything else?
Informal contract.
Another one is
Verbal contract.
third one. Another one is
And verbal.
I will kill you, Hamid, I will kill you. When you are going vacation?
Because you're fasting too much hard.
Imply.
MashaAllah.
That's it.
Or body language.
Yes. Check hand. In
Ah,
UK, right?
this one I need to remember.
Now you remember.
I remember. And this one only.
Yeah.
This one, right?
Eye contact and body language and all that.
When they go to the flat and they some, I remember.
You remember this, no?
Yeah.
So, you can create or make a contract or an agreement in this way. What is an agreement? Agreement or a contract? Contract is an agreement between two or more parties in setting up or to execute some performance in order for in exchange of a consideration. So there should be an agreement, there should be two or more people that should execute certain performance, and that should exchange consideration. This is what an agreement or contract is. An agreement between two or more parties that creates enforceable rights and obligations. Once you sign up, you are committed to that. You have to exercise these obligations.
Same as our contract. Our contracts. What we are giving to the tenants, it's a contract.
And yesterday I went to Uridu. What happened? Our landlord came up and connected internet for free. I already have internet connection from Uridu. Then I was wondering what to do. I went to Uridu and asked whether can I disconnect. Oh yes sir, you can disconnect. Then they said okay, you need to pay 1,695 riyal in total to disconnect. 3 month rent, device, installation charges, everything. So I have already, they show on the screen, small box, they make it big and it's a please sign here. So they show that, okay, you signed this agreement, kalas. Yes, mashallah. So once signed, in our language we say khatam, kalas. Yeah, khatam ho gaya. So that is one of the terms that you need to have. And then secondly, performance obligation. Now, from where will you see the performance obligation? Which document? This contract will tell you what are the performance obligations are. Either to sell goods, either to sell services, either, see, you have this AMC. Do you know what is AMC? Annual maintenance contract. In your real estate business, contract is very famous. So what is the contract? You have landlord, you have tenant. The landlord is issuing a contract where tenant with whether they are reading it, they are not reading it, they are willing it, they are not willing it, you got to sign it. That's it. 3 or 4 pages, and they will point us, okay, please sign here, please sign here, please sign here. You just simply,
So our contract is it.
I see how much So then, so those every single terms derived to safekeep the landlord, not the tenant though, most of the time. But anyway, we believe it's just and fair. So that contract will spell out what are the performance, this contract, reason for this contract. For example, if you sign up the real estate or the renting a premises contract, the performance obligation for the landlord is to allocate a space for the tenant to come and stay. And maybe they say that, okay, we provide security, we provide maintenance, we provide free, for example, free internet, so on. So these are the performance obligations of the landlord. Conversely, tenant also do have certain performance obligations, paying the rent on time, not to damage the property, not to disrupt your co-tenants, and so on. So these performance obligations are identified in. So what are these? A promise in a contract with the customer to transfer to the customer either a good or a service, sometime a bundle of goods or service. Let's discuss about that. Bundle of goods or service that is distinct. Now what do you mean by bundle of goods or service? Sometimes, without our knowledge, when we buy a good, we also purchase services, but in the invoice, it will not reveal. That's the example I picked just before. When you happen to purchase a photocopy machine, invoice will say 19,500 riyals. And it says that we will give you free parts and services for the next 3 years. Now, do you think that free part the parts and the services for 3 years is totally cost free for the photocopy supplier?
No,
No.
it's already in the invoice.
So they package it in such a way that the invoice is already there. In case if the photocopy supplier to sell only the photocopy machine, probably the selling price could be 16,500 or 14,500. Now what is the selling price? 19,500. So you have a 5,000 real difference. This 5,000 real, they have taken it in order to provide parts and services for next
Yes.
3 years. So then, how you think we should book our from the photocopy supplier point of view? How he should recognize his sales? What do you think?
After the customer purchase and pay all.
For the now you see scenario like this. Here 1, 2, 3. Transaction took place here. Cash 19,500, and then I have to credit somewhere. At this point of time, let's say I credit to customer account, customer A, for example, 19,500. Now I am reaching to end of year 1. When I am reaching to end of year 1, in my profit and loss account, how much I should show as what do you call my income? For the sake of ease of calculation, I say like this: 13,500 would be the device cost, 6,000 including the 3 years service. So how much I should book income from this 19,500 on the first year? 15,500. But you have done, you have taken 13,500 fully, the item has been sold, and plus from 6,000 you only need to take 1/3, which is 2,000, so 15,500. So then you need to take 15,500 from this and remaining 4,000. What will you, how will you show this? That is deferred revenue. Every year you will amortize back to income statement. So a series of distinct goods or services that are substantially the same and that have the same pattern of transfer to the customer. So these are known as performance obligation. Then we have transaction price, the amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods or services to a customer, excluding amounts collected on behalf of third parties. So these are certain definitions that we needed to understand. As I told you, you see the main criteria here. Transfer of control. Before it is risk and rewards. So that is the main criteria. Now we need to confirm how I know I have the control, or whether I have transferred the control or not. These following are certain indicators. The entity has a present right to payment for the asset. Now I confirmed that TV, hooked it, and then I said that okay, tomorrow I'm paying. Then they reserve it, they kept it separately for me. or you talk about a maintenance service. You already signed the contract. So the checks will be given in a week's time. So the customer has legal title to the asset. Customer should be the legal owner. Now what will happen? What do you think about a washing machine from the warehouse to the customer's house? It's going through the vehicle of the showroom and meets with an accident. Who is responsible?
So terms,
Supplier.
also the terms and conditions.
Yeah, no. If the supplier is delivering the washing machine to your home on Salwa Road, met with an accident, washing machine damaged.
Supplier.
Supplier.
Okay, same like can be shipping some items.
Yes.
Agency very different. So item coming from abroad, no?
Yeah.
There are terms of this sort.
Yeah. Correct. So that exactly. So in that you got to see what are the terms
In the terms.
stipulated in the contract. And also there in the international shipping you have this CIF and XOB
X1.
and so on. So the customer has legal title to the asset. The entity has transformed physical possession of the asset. Washing machine has gone to his home. Halas, it's now in his home. Not the new owner is washing his clothes. Only that house owner washing his clothes. The significant risk and rewards of ownership have been transformed to the customer. See, now what has happened? If I draw a circle and if I name this control, and I will draw another circle and I will say risk and rewards. Having risk and rewards is part of or example of having control. So that's what when we talked about IFRS 3 or IFRS 10 consolidation, we discussed that as well. The 5 steps to recognize and measure revenue. So first you need to identify contract. Contract is only in scope when both parties are committed, each party's right to be transferred can be identified, payment terms can be identified, the contract has commercial substance, it is probable the entity will collect the consideration. A contract can be written, verbal or implied. Secondly, identify performance obligation. A performance obligation is a promise to transfer good or service to customer. A performance obligation should be accounted for separately provided the good or service is distinct. Where a promised good or service is not distinct, it is combined with others until a distinct bundle of goods or services. So you got to have clearly identify the performance obligations and determine transaction price, how much. What is the sale value? The amount to which the entity expect to entitle, probably weighted expected value or most likely used for variable consideration. What is variable consideration? The revenue or the price could vary based on certain possible performances. Accordingly, the revenue may vary. And you may agree a revenue over several years. Then to recognize revenue for the current year, we then have to incorporate a mechanism, a mathematical mechanism known as discounting factor. But if the revenue period is less than 12 months, you don't need to do discounting factor. Discounting not required where less than 1 year. Allocate transaction price to performance obligation. That's what I did here. See, now my total transaction price is 19,500. I have two different performance obligations. Selling washing machine. That means the goods. I have sold the goods and then offer maintenance. So here we identify two different performance obligations. Accordingly, I split the revenue in that order. Recognize revenue when or as per obligation satisfied. So okay. Office Solutions Company, a limited company, has developed a communication software package called Consult. Office Solutions Company has entered into a contract with Logisticity Company to supply the following: license to use Consult, installation service. This may require an upgrade to the computer operating system, but the software package does not need to be customized. Technical support for 3 years. 3 years of updates for Consult. Office Solution Company is not the only company able to install Consult, and the technical support can also be provided by other companies. The software can function without the updates and technical support. Explain whether the goods or services provided to Logisticity Company are distinct in accordance with IFRS 15 from contracts with or revenue from contracts with customers. What do you think? Office Solutions Company, a limited company, has developed a communication software package called Consult. Office Solution has entered into a contract. Already, this Office Solution Company has entered into a contract with another company called Logisticity Company to supply the following. They will supply what? They supply a license, and they will also do installation service, and then they will provide technical support for 3 years, and then 3 years of updates for Consult. But they also say Office Solution is not the only company able to install Consult. So it's not a exclusive meaning for Logisticity. Office Solution is one customer. There are other customers also purchasing this. And the technical support can also be provided by other companies also. Not only Logisticity need to do this. If Office Solution needs this technical support, they can seek or approach someone else. The software can function without the update. Although you don't need to you don't need the updates for the software to function. You can say that I don't need. But here, this agreement has provided out. What in other words they try to say. Now, for example, this software 10,000. Updates another 3,000. So total how much? Now they are signing up a contract for 13,000. And because you signed up the contract, I am giving you this free. That's what they are saying. But from the person or the customer who is purchasing, he can say that I don't need the update. I can still live with this. So we wanted to understand whether this contract is something called distinct. See, these two I can separate. I can distinct both. was delivered before the goods or services and remains functional without the updates and technical support. It may be concluded that logisticity company can benefit from each of the goods and services either on their own or together with other goods and services that are readily available. The promise to transfer each goods and services to customer are separated. In particular, the installation service does not significantly modify the software itself. Why? You can do your own installation. And as such, the software and the installation service are separate outputs promised by Office Solution Company rather than inputs used to produce combined output. Now, for example, you purchasing a plant. When you're purchasing a plant, there are so many configurations. And if you don't do those configurations, you can't have the plant. Then that is not distinctive. You cannot separate it. But here it is not the case. In conclusion, the goods and services are distinct and amount to 4 performance obligations. What are those 4 performance obligations? These 4 different scenarios. Understand? So, that's the answer for that question. And I have the PowerPoint presentation also. I will share that as well. Now, we discussed about determine the transaction price. The transaction price can be a variable consideration and non-cash consideration, consideration payable to a customer, and an existence of a significant financing component. Sometimes, they say that you purchase now at a price and you pay now at a price, or you pay after 3 years, or meaning monthly installments, your price will be different. And they don't say that, they have configured the interest there. So you have to understand that. So what is this now? Okay, we don't need to do calculations now. A mobile company give customers a free handset when they sign a 2-year contract for the provision of network services. The handset has a standalone price of 100 and the contract is 20 per month. So how to work out? I will share the question now. Yeah. So how many months contract? Each month we need to pay a rent of 20 and for 24 months. So how much is that? 480. And what is the cost of the device?
100.
So this 100 is the cost of goods or the revenue from goods. 380 is revenue for the services. This is very common in UK. They don't sell devices, they sell the services, and they make a minimum commitment period like 24 months or 36 months. This every month the rental is mandatory and they give you the device for free. And you end up into that, and the selling company recognize the revenue in this basis. So that is the answer to that representation and accounting entries, where the entity undertakes a contract with performance obligations satisfied over time, such as construction of a building. Please watch this carefully. The entity must determine what to exclude as revenue and cost in each accounting period. There may be either a contract asset or a contract liability in the statement of financial position. There are three different ways that a contract with a customer may be presented in the statement of financial position. You can show as receivable, you can show as contract liability, and you can show as contract asset. If an entity's right to consideration is unconditional, only the passage of time is required before the payment is due, it should be recognized as receivable. What do you mean by that? You understand this or not? You have done a sales. Okay? And the consideration is, the only thing is, the right to consideration is unconditional. See, for the seller, somehow I need to get rid of this furniture. I mean, in buy and go, whenever you have money, pay me. Then you pass the double entry. Debit, receivable, credit, sales. You wait for 1 month, 2 months, 3 months, 6 months, you will pay. So that is when you recognize or you book receivable. Contract liability. If a customer pays consideration or the entity has a right, an amount of consideration that is unconditional, at the time of signing the contract, customer has to pay extra money in advance. Like you import things from China or any foreign country, you have to send advances. Then only they will dispatch the goods. So that you need to recognize as liability from the Chinese company until the performance obligation is fulfilled. Before the entity transfers the goods or services to the customer, the entity should present the contract as a contract liability when the payment is made or falls due, whichever is earlier. That's a different. Even is the same thing what we are talking about. Third one, contract asset. If the entity transfers goods or services before the customer pays, it should present the contract as a contract asset. If the entity's right to consideration is conditional, see the first box and the third box, the difference is what? The term unconditional and here conditional. On something other than the passage of time. Example, the entity's performance. You will only, like retention. All of you know what is retention is? Yes or no?
No.
Retention in a contract. Let's say 100,
sometimes 10%.
5%, 10% like this.
Yes.
In a contract, let's say $100 million. See, you keep on paying it. At one point, you will withdraw 5%, for example, or 10%. You don't pay until for another given period. Like one day, they put up a building. After 3 months, if the building collapses, what will you do? So, from the date you get the certificate of completion, you wait for another 3 months, 6 months to have a satisfied performance. You don't pay. That we call it retention. So retention is a contract asset, and it is conditional not on passage of time. Conditional on something other than passage of time. See, this is a calculation. Comes from IAS level. Contract asset, how I recognize contract asset? You see, is recognized when revenue has been earned but not yet invoiced. Revenue that has been invoiced is receivable. Now, what happens is, in a contract, let's say, have you heard of something called work certified? Percentage of completion? These terms?
Answer.
Yes.
Yeah.
Yes, boss.
You answer that.
That's the question.
Work completion.
I will definitely give you
Work certified.
or percentage of
If you don't know this, at least you make the payment without reading the contract.
Percentage
You
of-
can pay.
See,
This is for
I have
work in
the-
progress.
I have something called
40% like this. Work progress like this, right?
full contract value. I have something called full contract value. And the contract will not finish it in 1 year. It will go on to several years or several phases. Then it will what you call cost incurred to date. You will know what are the material, labor, overheads so far incurred. And also there is something called cost to completion. The remaining cost that you need to incur in order to complete that. So you will then know the total estimated cost of contract. Okay? And then you know the contract value, and then you know the total estimated cost of contract. Then this is the contract profit. What is the contract profit? This minus this. Then secondly, there are independent people who certify the contract work so far completed. They issue certificates. Based on that certificate, we understand. Also, from a construction industry, there is something called Gantt chart. Heard of this chart? What is Gantt chart? Have you seen a diagram written in engineer's office in different colors?
I see.
You see this one? And then here you will also, next time when you see, please see the parameters of X and Y.
I see this.
Okay?
In
This
for
chart,
starting the building,
Yeah.
they have the graph that they
Mm.
call it.
Correct.
I know this.
so this chart is what you call a Gantt chart to understand the progress of the work, progress of the construction. So accordingly, I can calculate something called percentage of completion. Now they will give me the work certified. Or from the work certified, divide by full contract value into 100 will give me the percentage of completion. So according to that percentage of completion, I can book the cost. So this is the total cost, and this much percentage, like a 28%, for example. So of that 28% will be my cost of contract, and accordingly I can split the actual revenue of whatever we have completed based on the percentage of work complete. Sorry, work certified. So then, see now.
Who certified the work? That was questions. Who certified the work? If you don't ask question, you'll assume that you know. Who is certified?
Not individual agent.
Huh?
Individual agents.
Individual agent is certified?
The
The project manager is certified. Not everybody can certify. Or the CEO.
authorizer.
If you are building a building, right, there will be one project manager allocated for it. Right? Here we made the certification.
Typically, is what
Technical.
independent people should do this
Technical.
certification.
It cannot.
If you don't have independent, then
Yeah, but
Project
mostly
management.
practically what happens project
yeah,
manager.
but practically
When
they
you
don't
go
hire.
here, in GC, he will have individual managers for each project.
Operation manager.
Not all project
Project
manager. Project manager, operation manager, but they normally call project manager. For example, Alrayan they have separate manager. Must look like that. So other unit they have separate manager. So that manager has to certify that this work has been done, and they will give a percentage. For example, 1 million is the total value of the contract. They will give 15% work is done this month. Maybe this will run for 3 years. Then a 1 million, 15% you take as the revenue. Okay? Because individual, if you are trying to get individual, it's only cost you, somebody else will pay. Normally they have a project, one project manager. It's practical aspect I'm talking about.
Right? So, then, that detailed calculation I don't want to go into, just to explain this portion only. So, revenue has been earned but not yet invoiced. So, that's what I wanted to explain. Now, you sign a contract, you perform, then you split a portion as revenue earned. Revenue earned you will show as contract receivable. And then after you start invoicing it, from this point it is not going to go P&L. It will not go to P&L. So you invoice it, every single invoice will then take you to profit and loss account. And then here you have contract receivable. And then here you will show as in the balance sheet. Understand me? So, revenue recognized based on the percentage certified to date minus the amount invoiced to customer to date is the difference between sometime your revenue 100, amount invoiced is 110. So you understand that. Your revenue is 100, invoiced 110. So you have minus 10. This is liability. That's called contract liability. Whereas if the this one is 80, then you have 20. Yeah, that is asset. So common types of transactions: principal versus agent. You know this type of examples of transactions: principal versus agent. Here you have you seen any agency business? Anchor. How many of you purchasing Anchor milk? They don't.
They don't.
They don't buy Anchor.
They don't.
What
They
milk?
don't.
What milk you are drinking?
Lebanon.
Nido. Okay. Forget Anchor. Nido. You think Nido?
It's a milk powder. Then they
Oh, okay. Milk powder.
Sri Lanka they use mostly commonly anchor milk
Anchor.
powder
Milk powder.
for tea and
So, yes, tea with milk. So the Nido, the owners are operating in Qatar. Okay, Coca-Cola. Forget Anchor. Coca-Cola. Owners operating in Qatar? No. They have come up, signed up with some agent. So the agent needs to do the distribution. Production takes place by the principals. But the selling is happening by agent. So based on the principal agency agreement, the revenue will be recognized. There is something called agency commission, and there is something called
Agent and distribution also separate, right?
pardon.
Agent and distributor.
You can't really say that. The agent can be a distributor, but distributor may not be an agent.
Security.
Hmm?
Security number.
Yeah.
Wilson.
Hmm.
Uh,
So you are the agent for Wilson.
Wilson.
Hmm. So an agent can be a distributor, but a distributor may not
Agent.
necessarily an agent. The reverse is not true. So any idea about what is this term? Del Credit Commission. The normal commission, agency commission, what happens in a normal arrangement, what happens is principal, agent and customer. Agent will distribute the goods to customers and the invoice actually is going from principal to customer. The customer should pay to principal, not to agent. But agent will collect. Who is the responsibility to fully collect the dues from customer? In a normal,
By the way, he explained this before. Huh?
Yes.
Thank you.
so we talked about this before. So, in
So
a normal,
that time the
yeah,
name.
in a normal arrangement, principal is responsible to collect the dues from customer. Then, what is the revenue for agent? The commission. Normal commission. Only for the sale, and he will receive that only after fully receive the dues from the customer. But if the agent undertakes the responsibility for bad debts also, then the principal will allow or award extra commission. That commission name is Del Credit Commission. Sales with right of return. Now sometimes it's a lease arrangement. Sale or lease, sale or return, finance lease we talked about. That is that. Consignment arrangements. You have like consignments are coming from different countries, and then you undertake that and you distribute. Bill and hold arrangements and warranties. So these are different possibilities. So okay, this we don't need to worry about that. Let's look into this diagram. An entity sells an item to a customer with a right or option to repurchase. There are three forms of this. Obligation to repurchase the asset. Obligation to repurchase the asset, we call it forward contract. When we study financial instruments, we will go into very detail of this. A right of repurchase the asset, we call it call option. Obligation to repurchase the asset if requested by the customer, put option. So this call option, put option, don't worry. In the next week, these are our detailed discussion. Consider whether or not the customer is likely to exercise the option. If the repurchase price is greater than or equal to original selling price, treat as financing arrangement. If the repurchase price is less than original selling price, it is outright sale with right of return. So this diagram, I will share it, but I will discuss that in our next okay, that's it. So with that, IFRS 15 is done, and next week I will try to finish by Wednesday the financial instruments. By then we can conclude our sessions.
Any questions?
Yeah.